You know, when engineers design a suspension bridge, right? They don't just calculate the exact maximum weight of rush hour traffic and build it to hold exactly that.
Right. Yeah, they build it to hold like 5 or maybe 10 times that amount.
Exactly. And welcome to today's deep dive, by the way. I'm your host, and today we're looking at the investing philosophies of Benjamin Graham and Warren Buffett.
Glad to be here. And yeah, our mission today is uncovering the exact strategy that protects smart investors from, well, catastrophic loss.
So, I mean, how does bridge engineering actually apply to your portfolio? Like, what's the connection there?
It really comes down to what Buffett calls the 3 most important words in investing, which is margin of safety.
Okay, so if we stick with the bridge analogy for a second, what is the actual weight limit in the stock market?
So the weight limit is basically a stock's intrinsic value. The margin of safety is that physical gap between the actual value and the price you pay.
Right.
Like, say a business is fundamentally worth $100 a share based on its assets and the cash it generates. If you can buy it for $60, you have a 40% margin of safety.
Oh, wow. Okay, a 40% buffer sounds amazing. But I mean, Wall Street isn't exactly famous for handing out free money.
No, definitely not.
Right. So if a stock is selling at 60 but worth 100, isn't there usually a reason? Aren't I just catching a falling knife at that point?
Well, that is the billion-dollar question,
Yeah.
right? Sometimes, yes, a company is cheap because it is genuinely failing.
Yeah, that makes sense.
But Graham's core insight is really about built-in forgiveness. Because, you will be wrong.
Wait, really? Just inevitably wrong?
Oh, inevitably. Your math on what the company is worth will be slightly off, or a CEO might get caught in a scandal, or the whole economy might tank.
So those are the unexpected heavy trucks on your bridge.
Exactly. That 40% gap absorbs those hits without completely wiping out your original investment.
Huh. So a 40% discount with built-in financial forgiveness. Why isn't everyone just trading this way? It seems obvious.
Because it requires something much harder than math. I mean, it requires an agonizing level of emotional control.
Ah, emotions.
Right. Yeah, the margin of safety investor has to buy when everyone else is terrified and sit completely still when everyone else is euphoric.
Yeah.
We really need to focus on how much emotions hinder investors, because that's the real trap.
Which is basically psychological warfare against your own brain. I mean, think about how painfully difficult it is to sit in cash doing absolutely nothing while all your friends are getting rich overnight.
Right, on the latest tech stock or some crypto run.
Exactly. The FOMO is entirely overwhelming. You just feel like you're missing out.
And that is exactly how the crowd gets trapped. People feel the safest when prices are surging, when momentum is high.
Because they feel validated by the herd.
Yeah, exactly. But mathematically, buying at the absolute peak of a hype cycle is when you are taking the maximum amount of risk. You literally have zero margin of safety.
That is a terrifying thought. So the market itself doesn't destroy investors. Their own greed and fear do.
Spot on. Patience is really the main strategy here. It is what separates the winners from everyone else.
Okay, so how do we systematically strip those emotions out? Like, how do we actually do this?
Well, our sources lay out a 3-step framework.
Yeah.
And it starts with actually figuring out that intrinsic value.
But wait, figure out what it's worth sounds great on paper. How does a normal person actually do that? Like, logistically?
I mean, it takes work. You have to look past the stock ticker and look at the actual business. Like, what does it own?
Right. The hard assets.
Yeah, what are its hard assets?
Yeah.
And, crucially, how much reliable cash is it going to generate over the next 10 years?
Okay, so you get that number. Then what?
Once you have a conservative estimate of that number, you move to the second step, which is demanding a massive discount. Graham usually looked for at least a 33% margin.
Why 33% specifically? Is that just a magic number?
Well, because a third off gives you enough padding to be completely wrong about your growth estimates and still not lose your shirt.
Ah, so it's a literal buffer for human error.
Exactly.
Hmm?
Think about when Buffett bought American Express back in the 1960s. The company was caught in this massive loan scandal.
Oh, right. The stock price was basically cut in half, wasn't it?
It was. Wall Street was totally panicking. But Buffett looked at the intrinsic value of their ironclad monopoly on traveler's checks at the time and realized the price was so low, his margin of safety was enormous.
So he bought when the fear was highest, which I guess ties into the final and probably most frustrating part of the strategy.
Yeah, patience. waiting for the market to offer you that exact discount, even if it takes years.
Years, wow. That takes some serious discipline.
It does. It reminds me of a great point Buffett makes. He says, more money is actually lost by investors trying to anticipate and prepare for market corrections than is lost in the corrections themselves.
That is wild, but it makes sense. The discipline to sit and do absolutely nothing is incredibly rare.
But it's your ultimate advantage. Price is what you pay. Value is what you get.
I love that. So the next time you find yourself asking, like, is now a good time to buy? Remember that the answer has nothing to do with what the Fed is doing.
No, or where the broader economy is heading. It depends entirely on whether that margin of safety is sitting right in front of you.
Right, because it's ultimately a philosophy of humility, isn't it?
Yeah, you are admitting you can't predict the future, so you build a bridge strong enough to handle the unknown.
That is a perfect way to put it, which leaves us with a final thought for you to explore on your own.
Yeah, think about this.
Since this whole principle acts as a buffer against our inevitable blind spots and errors, how could you apply a 33% margin of safety to other high-stakes emotional decisions in your life?
Oh, that's a really interesting angle. Like how you manage your daily schedule.
Exactly. Or even your long-term career choices. If you actively built in that extra capacity for things to go wrong, what kind of collapses could you avoid?